The truth is, the Canadian government and the CRA want you to pay more taxes. And over the past few years, taxes in Canada have just been increasing, making it more and more difficult for you to build wealth. Now, claiming some tax credits here and there might save you a few $100, but this honestly isn't going to make much difference, especially in the long run. And so that's why in this video, I'm going to share with you 3 legal ways to pay less taxes in Canada that will actually make a difference in your life. Hey, if you're new here, my name is Michael Lee Kim and I'm a personal finance coach, CPA, and TEDx speaker. And my goal is to help you learn how to use money to design a life you actually love. The first strategy is literally one of the only ways you can reduce your taxes if you're an employee. Now, the problem with being an employee is that if you get paid $100,000 by your employer, you have to pay taxes on the full $100,000. There's no real way around this except for using registered accounts, aka your RSP, TFSA, and FHSA. So how it works is that any money that you contribute to your RSP or FHSA is seen as a before tax deduction. And what this allows you to do is reduce your taxable income, which is the amount of taxes that the government is allowed to tax you on. For example, let's say you're making $100,000 per year, and assuming a flat 30% tax rate, you would have to pay about $30,000 in taxes, leaving you only $70,000 of take-home income. Now instead, let's say you were to max out your RSP and FHSA contribution limits for the year. In this case, the RSP contribution limit would be 18% of your income in the previous year, and the max contribution for your FHSA would be $8,000. And so in total, your max contribution room for these two accounts would be $26,000. And so once again, you're making $100,000 per year, but then you decide to contribute $26,000 into your RSP and FHSA, reducing your taxable income. And so now instead of being taxed on the full $100,000, you're now only being taxed on the $74,000, which means you only have to pay $22,000 in taxes, saving you $8,000. Imagine that, saving an extra $8,000 every single year. Now this will actually make a difference. Another benefit of using registered accounts is that any investment income generated within this account is either going to be tax deferred or tax free. Tax deferred means that you don't have to pay taxes today, but you have to pay taxes when you take money out of this account. While tax-free means that you don't have to pay any taxes on this investment income ever. And so the RSP is tax deferred, while the TFSA and the FHSA are tax-free. And the benefit of paying no taxes is that you allow your investments to grow and compound without triggering any taxes. For example, let's say you were to invest $10,000 per year over 30 years at an average annual rate of return of 8%, assuming a flat tax rate of 30%. Now, if you're investing this money in a regular unregistered account, then by the end of 30 years, you would have $790,000 in this account. But instead, if you were to use a TFSA, where any investment income is going to be tax-free, you would have $1.13 million. That's a $340,000 difference. And I don't know about you, an extra $340,000 would be pretty nice. Now, if you want to learn more about the RSP, TFSA, and FHSA, then after this video, make sure to watch this video where I share about the 2025 changes to these accounts, as well as how to actually use these accounts. The second strategy to pay less taxes in Canada that will actually make a difference is one of the most important lessons that I learned in my tax course back in university. And so employment income is actually the worst type of income because there's not much you can do to reduce your taxes other than registered accounts, which is what we just talked about. But with business income, it's a lot more flexible. The first benefit of having a business that generates business income is that you can reduce your business income with any eligible expenses. This is also known as a write-off.
That's a write-off. Do you even know what a write-off is? Yeah.
For example, let's say you're an employee making $200,000 per year. Assuming a flat 40% tax rate, since we would likely be in a higher tax bracket, you would have to pay $80,000 just in taxes, leaving you about $120,000 per year. And to make things worse, as an employee, you still have to cover a lot of the expenses that you need in order to work, like your phone and internet bill, getting to work, and more. And so for this example, let's say all of these expenses add up to about $30,000 per year, which means really at the end of the day, you only have $89,000 of take-home income. Now instead, let's say you were to have a business that also makes $200,000 per year. Now assuming all of these are eligible business expenses, as a business owner, you can reduce your taxable income by writing off these expenses from your income, which means instead of getting taxed on the full $200,000, you're instead going to be taxed on $200,000 minus all of the eligible business expenses, where in total you would only have to pay about $68,000 in taxes. And the difference is over $12,000 per year. And as you can probably tell, this gets even more important when you're making more money because you're in a higher tax bracket. And in some of the highest tax brackets in Canada, you're paying more than 50% just in taxes. And if you think this is good, it gets even better. Second benefit of having a business is that you get to choose how much money you make in a year. In Canada, when you have a business, you have a choice between being a sole proprietor or a corporation. And the major differences between these two businesses is that any income generated by your sole proprietor has to be claimed under your personal income. For example, if your sole proprietor made $200,000 this year, you would have to pay taxes on $200,000 minus any eligible expenses. But if your business is a corporation, in the eyes of the government, they see your corporation as a separate entity. And so if your corporation is making under $500,000, your corporation would be taxed at the corporate rate, which is between 9 to 12% based on the province that you're in. And then you get to choose how much the corporation pays you for the year. And so even if your corporation made $200,000 this year, you can choose to only pay yourself $100,000 of that amount of money. And this can significantly reduce the amount of taxes that you need to pay. And this is why it's so important to understand the differences between employment income and business income. Because even if you're making $500,000 as an employee, almost half of this amount of money will go directly into taxes. Meanwhile, if you have a corporation that's making $500,000, there's so many more tax optimization and tax planning strategies that you can implement in order to pay less taxes and keep more of your hard-earned money. And so remember that $500,000 of employment income is not equal to $500,000 of business income. Now, the third strategy in order to pay less taxes legally in Canada is one of the oldest and proven ways to build wealth, which is through real estate. And there's two main benefits. The first being the principal residency exemption. In Canada, let's say you bought a house for $500,000 and then sold it a few years later for $1 million. This would trigger a capital gain of $500,000. And now before 2024, 50% of this capital gain would be taxed. But as usual, the tax man always wants more of their money. And so the Canadian government and the CRA actually implemented a new tax rule that any capital gain above $250,000 is actually going to be taxed at 66.7%. And once again, if we're assuming a flat 30% tax rate, you would have to pay over $100,000 just in taxes. But if this house was your principal residence, aka the house that you lived in, then you don't have to pay any taxes at all. And this is how so many people have been able to become millionaires, because they literally bought a house for $100,000 and then 30 years later they sold it for like $1 million. And they don't have to pay any taxes at all if they use the principal residency exemption. But a misconception that a lot of people have is that they see their principal residence as their one and only asset. And so they buy a big home with a big mortgage, and then all of their income and savings go directly into this house. This is what my parents did. But the thing is, the house that you live in is a dead asset. Because although your house is hopefully appreciating in value every single year, you don't have access to this capital unless you decide to sell your house. But you can't sell your house because this is the house that you live in. And so this is how you find so many millionaires literally living paycheck to paycheck. Because other than their house, they have no other savings and investments. And this is what it looks like to be house poor. And so to avoid this, the best way is to use real estate to create another source of income. also known as rental income. And similarly to business income, with rental income, you can actually reduce your rental income with all of these eligible expenses. And when you use real estate this way, you're building wealth in real estate in three main ways. The first being the appreciation of the house price. As the value of your house increases, you're building wealth. The second is the cash flow that you're generating from any rental income that you're generating. And lastly, as you're paying down the mortgage, you're building equity through this process. And this is how you can make, keep, and grow more of your money through real estate. Figuring out how to pay less taxes in Canada legally is like playing a game of Monopoly. You can play the game without learning the rules of the game and pay a lot of taxes. Or you can learn the rules of the game and play to win. And the reason why rich people become rich isn't necessarily because they work hard, but it's that they work smart. My parents are some of the hardest workers, and yet they really struggled financially because they didn't learn the rules of the game. So if you want to start learning the rules of the game so that you can work smarter, not harder, then apply to get a free financial audit with me, where you get my eyes and expertise on your specific financial situation to help you achieve your financial goals. To apply, just go to michaelleekim.com/audit. Also, next week, I'll be releasing a new video of a real-life financial audit that I did for a doctor who is making over $250,000 per year and yet still living paycheck to paycheck. And so if you want to learn how this happened and how I helped him, then make sure to like and subscribe so you're notified when I release this video. In the meantime, if you want to learn more about the TFSA, RSP, and FHSA, and the 2025 tax changes to these accounts, then make sure to watch this video right over here.